Topic yesterday is why crypto VCs are becoming more like hedge funds. With us is the CEO also and co-founder of Pear protocol, UF.
Thank you so much. So let's talk about crypto VCs, a dying breed. So crypto VCs, you may have noticed, there is this trend that they are becoming more like liquid token funds. And within that, some of those liquid token funds are starting to look a bit more like hedge funds. Now this is hardly surprising because crypto VC, as you know, is on hard mode, both in terms of capital, raising LP capital, and then also in terms of deploying that into deal flow. So what we've seen is, despite a little post-Trump election blip, both of those trends are reversing again. It's getting harder and harder for a crypto VC to raise money, and it's getting harder and harder for them to find deals worthy of investing in. And I would say that, on the whole, crypto VCs have a bit of an existential problem. Not only that, but about 20 firms, the big ones, A16Z, Dragonfly, Pantera, they make up more than 60% of all the total capital deployed. So the real question is, what happens to all these tier 2 and tier 3 crypto VC firms? Well, we know the problem they have. The old venture model in crypto is broken. It used to be the case that you would invest early in a pre-token generation project, you would wait 3 to 5 years with some lockup, and then you would monetize this through a SEX listing. That, unfortunately, is gone. Memento Research, they looked at 118 token launches in 2025, and they found of those, nearly 85% of them were down on the year from after they launched. Not only were they down with a median FTV of negative 71%. So what's that story telling you? It's telling you that retail is gone. There's no marginal buyer for the next token event that takes place in crypto. And so that raises a big question. Do we stop allocating long only to crypto as an asset class? Because that's what these people are asking themselves. I want to introduce the idea of the great dispersion. So it's not necessarily the case that you don't deploy to crypto. It's more the case that the good assets, the ones with product market fit, the ones with users, the one with revenue, things like Hyperliquid, for instance, or even XRP or things like this will continue to do well, whereas the bad tokens with no usage and token unlocks are going to continue to do poorly. Now, this dispersion is a feature of the market which, if you're a fund, you kind of inherently know that this is going to continue. We've started to see this in 2025. It's been playing out in 2026, and I think it will be a dominant theme for anyone allocating crypto over the next couple of years. The question, though, is how do you then capture such dispersion in returns? Now, anyone who has worked in TradFi will be familiar with the idea of pair trading. So pair trading is this idea that you long one asset or a basket of assets and then short another asset against it at the same time. The reason why you would want to do this is because it works in different market scenarios. So let's say you have a thesis. Hyperliquid is going to go up, but at $60, it's a little bit expensive. You could take a view of longing Hyperliquid and maybe shorting Solana against it. Now, in a rising market, which we're in right now, you make money when Hyperliquid goes up, even if Solana goes up. You make the spread or the difference. In a falling market, as an example, Hyperliquid could go down 5%, and Solana would have to go down, say, 8%, and you would still make that spread of 3%. And now we're about to approach the summer, which tends to be quite illiquid and choppy. And in those kind of sideways markets, this pair trading really is a strategy to utilize when the markets trade like that. And not only is it something that works in different market conditions, but the math is undeniable. So this is independent research from Delphi Digital, and they took a look at being long hype, and then they took a look at being long hype SOL. And when I say it's mathematically superior, what I mean is if you take a look at things like the annualized volatility, the max drawdown, and the Sharpe ratio, which is a measure of returns divided by volatility, being in the pair trade of hype SOL is significantly less risky than being outright long hype. Now, these are people who have traditionally been long only. There's a compelling case to go back to their LPs and say, look, I am doing these trades and they have a much better risk profile for the fund. That risk profile is significantly better when you trade a basket. So in that basket, you might want to be long hype. You might want to be long Bitcoin. You might want to be long ETH and a handful of other things that you think are producing revenue, and then short Cardano, OP, and the long tail of crypto assets against that. And so those kind of Sharpe ratios are almost 4 times better when it comes to pair and basket trading. These long-short strategies which our users have been doing on Pear protocol continue to perform very well. So there's Hype Sol, which that's an outdated chart now. You'd have to take the axis and kind of to see where that chart would go. And the same applies even if you diversified your short legs into Sol, Sui, Avax, Say, and Atom, for instance. What we're seeing on the platform is the proliferation of equities and commodities on chain. It means that people are doing unique combinations of long shorts. One of the trades on the platform right now is people going long Anthropic and short OpenAI. And you can do that on Pear. We've also seen people do trades like being long Monad and short Solana as like a thematic long short. And then we've seen people take these kind of more statistical-based long shorts where something decouples and they think that is a mean reversion opportunity as well. The challenge, however, for all these people, so we're talking about crypto VCs, we're talking about their existential problem. We've talked about the fact that they can't necessarily allocate long only like they used to. And the big problem for them is moving to long short in a safe manner. Because they have legal teams, they have compliance teams, they have a mandate, they have LPs. And the minute you say short, people get scared. And rightly so. You have to pay funding, you have the chance of potentially being short squeezed, you have the potential to be liquidated maybe even on that short leg. And so that short leg becomes really scary for a lot of people. So let's talk about how to address some of those concerns. Based on all the feedback and the crypto VCs we spoke to on the East Coast of America, European-based VCs, and then ones in Asia, they wanted a dedicated platform for pair and basket trading. And so we built it. It's called Pear Pro. It's been live for just the best part of a month now. And this platform essentially is you trading the spread. So you're no longer just clicking a whole bunch of longs and shorts and then seeing how the individual P&L on them. You're trading the spread between them. And at the heart of Pear Pro is risk management. So when you trade a basket trade, you have one entry level. Let's say that entry level is at 95, right? You can set a take profit or stop loss on the basket level itself. So if the basket goes down 2%, you're stopped out of the trade. You can set a trailing stop. If the basket is doing well, start to take profit, etc. You could also do things like rebalance that trade frequently, because that's what people do in active management as well. The other thing I hear a lot is, okay, I can pair trade. I can go on Hyperliquid or somewhere like this, and I can click a long and a short, and voila, I'm pair trading. And we can tell you from experience, pair trading is so much more than that. You need to consider correlation between the assets. You need to consider things like the beta and how to size those trades. You might naturally think, oh, okay, Hype Sol, I'm going to do $50 long, $50 short, but that doesn't give you that market neutral exposure you want, because you might need to be 40 long, 60 short to kind of neutralize the beta in that case. And the platform will show you the suggested beta neutral weighting. The thing that I'm most proud of is we built something called Agent Pair, a dedicated agent to help people on their journey to do more pair and basket trading. So for instance, somebody that wants to say long Bitcoin and short some stuff against it, which makes sense, they could ask Agent Pair, hey, look, I want to long Bitcoin, suggest me 5 shorts against it and how to weight it. That AI agent then will crunch all the data, which is available on our platform about correlations, Z-scores, betas, etc., and it will suggest you a basket trade based on your risk profile. You can then have a continuous conversation with that LLM and say, okay, this trade is doing really well. How do you suggest I rebalance this trade? And it will run those numbers for you as well. This is the world we've moved to. These strategies which were exclusive to hedge funds, you can now do on-chain at a fraction of the cost. And so we've also reduced the friction to do these things, because we know a lot of these crypto VCs, they use Binance, they use Bybit, they use Coinbase, they use Kraken. So to get started on this is super simple. You just connect via API keys to your existing KYC venues, and it opens up the entire portal. Why are we the team to launch an institutional pair trading platform? We've been doing this since 2023. There's been over $1.6 billion of volume executed on Pear protocol. And we're a team of 14 people, mostly developer-based, solving a very niche use case in crypto, which is crypto VCs dying, there's lots of money there, they want to do more long-short positioning, how can I build it for them? And that's essentially how we've come to this kind of place. I want to double tap about the agent. There are lots of agents in trading in crypto. They're generalized, there's lots of AI slop, they're all using the same kind of thing, right? They're querying ChatGPT or they're querying Twitter or something. Our agent is hyper-specialized for you and your trades for pair and basket trading alone. And I think if I look at the way that trading is going, you're just going to have hundreds of specialized agents who are good at one very niche thing, and then those agents are going to speak to each other. And so this agent, for instance, has an MCP where other agents can speak to that agent as well. And you can tap that into your agentic workflows too. So let's recap a bit. We're seeing more of these traditional VC funds pivot to a liquid mandate. Within that liquid mandate, there's only 7 or 8 tokens they can realistically buy. And so some of those are becoming more like hedge funds. They're using platforms like Pear Pro. The bottleneck is risk and compliance with this. And I think the way that we have seen people come to the platform is it's not about long-short trading. Long-short trading feels very much like changing the mandate. What they're doing with the fund is they're moving to a fund that is doing long-short positioning. And they put those trades on. They might look at them once a week, once a month, discuss them at a high level, and then rebalance if they want to. And there's lots of tier 1 terminals, right? There's Talos, there's CoinRoot, there's InSilico, there's a lot of institutional terminals. We're solving one very specific use case, which is fundamental-based basket trading with this platform, with risk management at the key of all of this. So in 2026 and 2027, I think the message is clear. You either pivot or you die. That old model that, unfortunately, some of us are married to with 3 or 5 year lockups, directionally long with high drawdown risks we saw in that first slide, and hoping for some marginal buyer to come, that model is dead. And let's accept that that's dead and move towards a much more liquid pivot. By using a platform like Pear Protocol or even Pear Pro, you can lower the entire portfolio volatility. You can have hedged exposure, irregardless if the market is going down, sideways, or up. And most importantly, you can still leverage the skills of the investment team. Because these teams at crypto VC funds and liquid token funds, they have incredible analysts. These are the same people that can look at analysis and revenue numbers and trends and say, okay, I want to be long Morpho, and actually it's going to outperform Aave. And I need to be able to put that trade on in a risk-managed way. I need to be able to chart it. I need to be able to have risk management tooling around it. I need to be able to rebalance that trade. I want to chat to this agent about it, and I want to put that trade on. And that's what we're really seeing. These fundamental analysts are empowered by a platform like Pear. It doesn't detract and take away from their day-to-day job. They have a thesis on, say, being long hype, but they build conviction on how best to build a short basket against that hype long. And then they go back to their LPs and they say, hey, I can provide much better risk-adjusted returns. So a little bit about myself and why I'm so passionate about this is I spent 7 years of my career as a trader for Deutsche Bank in London. I was trading equity derivatives. And then I spent the last 3 years of my career actually speaking to institutions and building long-short portfolios. So when a UK pension scheme wanted to build and implement a long-short strategy, they would call me and my team, and we would work with every team internally from structuring to research to finance, legal, compliance, and then the traders to implement those long-short strategies. I got bored of that in kind of 2019, 2020, and I ran a long-short book in crypto. So I'm acutely aware of all these concerns of rebalancing and all of that when you're running a crypto book yourself. So if you want to start exploring more of this type of trading and you want to incorporate it into your workflow, whether it's via API, whether it's via coming to the UI, that's my email address. We have a booth here till Friday. But yeah, I'm happy to take any questions. I'm happy to have the opportunity to talk to people about a much different way of trading these crypto markets. Thank you.
Any question, guys? I can go for one, actually. It's funny enough, I used to work at Bloomberg, and one of my largest clients was Deutsche Bank, so I was in that exact trading floor in London, like, almost every afternoon. And I had to say, those guys are animals, they're not people. Now, what do you miss most about that life, actually, if you miss anything?
I think it's changed over time, but like it's a very cerebral place, right? So the trading floor in an investment bank in London, just like it would be in New York, is full of people from all over the world, and they're the best at what they do. And that kind of excels you to be better yourself. So in crypto, like, there's pockets of this, right? And you've just got to find them, right. Whereas in banking, everyone is of that high caliber. It's insane.
It's crazy, yeah. But the world is completely different. I mean, it's interesting because a lot of the people come here on the panel and they talk about, you know, traditional finance and how they are changing some bits of it, but it's very cool, the experience, and then went on to actually go and change it. Brilliant stuff. Any other question? No? Then another big round of applause for our guest, Af. All right.